Let's talk some bonds, all right? 10-year yield, we heard the case for why it could continue to drift higher over the longer term from James just now. But walk me through the short to intermediate term action that you see.
Yeah, I'm just kind of going, given the way the market's been. Well, first of all, thanks for having me back, Oliver. I really do appreciate it. The way the market's trading in here, I think it's really hard for a trader like myself, who's just looking out several weeks, several days. I'm not trying to get too big with my forecasts in here. I'm just trying to keep it relatively near term, given the relative chop that we're having. Yep. I actually see yields going lower in the near term, and that's about as far as I'm willing to kind of stake my claim. I think if we can get 10-year notes above this 129 level, actually 128.28, which is right where we're the high of the day here, give or take a couple of ticks, I think we could go higher from here. And of course, that would drive down yields. But that's just simply a trade. That's not anything based on, my view of the macro outlook going forward.
Got it. Now, Dave, when you think about using technicals on the Treasury, I mean, it's been such a wild trade. It's been more volatile than stocks for much of 2019. Is there a point to where if it does break further or if it breaks back out, I mean, how do you assess the trend right now for 10 years? What are sort of the areas that you look for to figure out, which way it kind of moves? Because we had this epic rally, and then the selling since September has also been pretty intense at times.
It has been, and I mean, it's obviously created a good environment for traders. It's been challenging, but there's definitely been opportunities. I think one of the things that a lot of people aren't talking about, although you're starting to see it kind of percolate to the surface, is the term premium. The term premium has been shrinking for the last couple of months, and that's kind of coincided with the decline in Treasury note prices and, of course, the rise in yield. So I think if that term premium continues to decline, that is not setting a very favorable backdrop for traders to be holding notes and holding bonds. The economy is kind of starting to pick back up a little bit. We had the recession scare back in August, the inversion of the yield curve, and it looks as though that kind of came and went. And it does seem as though the economy stabilized a bit. So, the argument for higher rates, if the economy continues to stay where it is, and even if it just moves at the current pace, that certainly leaves further rate cuts off the table for sure. Yeah. So it is entirely possible that we could see 10-year rates move a little bit higher if the term premium continues to shrink and if the economy kind of gets a re-acceleration, so to speak.
Got it. Dave, how about volatility? Let's talk some VIX here. As we mentioned, we were flirting with the 12 handle just this week. What do you look at now with vol?
Well, I normally don't trade vol. Obviously, I keep a close eye on it. I had sent over a chart earlier, and I don't know if you guys are going to put that up or not.
VXX, right?
What's that?
Or
yeah,
here's
that one
the VIX
right there.
futures, yeah.
I mean, that's again a very crowded trade in terms of expecting very little volatility in the VIX. And as you mentioned to the previous guest, that blew up in a lot of people's faces earlier. Will it happen again? I don't know. I'm not trying to forecast the vol market, but I am looking at it from the standpoint of where's my risk and reward. And if you're trying to short volatility in here, it just seems to me as though you're kind of picking up nickels in front of a steamroller. So, if I think that the market might, have a slight pause, meaning the S&Ps might trade lower for a period of time, maybe I'd like to own a call option on the VIX, or maybe I'd like to own a call spread. And if it works out, fantastic. It's a good trade. I've got limited risk. But I think if you're trying to bet on a continued decline in the VIX and a decline in volatility, that to me just doesn't have a good reward to or risk to reward ratio. So, for the record, I'm long a call spread on VXX, and if it works out, fantastic. But it's just one of those things that, in the event there's some headline risk and you get that VIX to pop, that's a trade that would play out really nicely. You get a good payoff, 3-to-1, 4-to-1, depending on how you structure it. So that's how I'm looking at the VIX at this point in time.
I love the positioning chart, CFTC. I've seen this circling, so I'm really glad you brought this to our viewers as well. We've mentioned it a few times here, but just to see it, it's pretty incredible. Just especially considering, all the bids into, gold and treasuries and the fear of recession turned so quickly into this short vol trade. VXX, to your point, obviously the penny's in front of the steamroller because this thing naturally just decays by nature of it. But can you give me an idea of what your call spread looks like, Dave?
Yeah, I'm just looking out towards the end of the year, and it kind of gives me kind of a frame of reference it allows me to give you a frame of reference as to how I'm coming up with that. I'm pretty bullish into the end of the year, but I think we might pause a little bit here on the S&Ps, and of course I'm going to circle back to the VIX because they're obviously all related. The sentiment's pretty extreme at this point. Dollar yen's having a hard time breaking out. Treasury notes look as though they're about to rally. So again, I'm not being bearish on the market. I actually think we'll probably rally into year end, but the market's just been so labored over the last couple of weeks. If we drop down towards 30.50, 30.20, that to me would be really healthy, and I think you might be able to reload your long S&P position or add to it if you're currently long. And it's that kind of a scenario that I would see where we might get a pop higher in the VIX. So I'm going out into December. I've got a December 1923 call spread on. And again, depending on how things work out, if the S&Ps do move lower and the VIX gets a spike, that's a trade that'll pay off pretty nicely. And if it doesn't work out, again, I'm not going to get my head taken off with it because you can control your risk on a trade like that. And I've got it set so that, my payoff is 3-4 times what I'm risking on it.
All right. Well, if we do get that sell-off and all those short, vol traders have to then chase, then you can see it taking place. I want to talk dollar with you real quick, Dave, too. The dollar's been real resilient despite so many, rotation type of actions in this market the last 2 months. Dollar just won't break its trend.
It won't, and it's become, I had an opinion on the dollar thinking it would be going lower, and that was a couple months ago. Obviously, I'm no longer in that camp. I'm actually kind of dollar neutral just because it just can't seem to get a good footing up or down. It's just been a lot of back and forth.
Yeah.
So for me, in currency land, I'm really more looking at some of the crosses. Where I've been having good luck lately is, trading the likes of, let's say, Canada versus the Japanese yen, because that's really more of a play on the S&P. So if you're an FX trader and you're kind of looking to play the ebb and the flow in the S&Ps, either CAD yen works well, dollar yen. Granted, dollar yen is going to have a component of dollar movement to it, but the fact of the matter is dollar yen is far more correlated to 10-year note rates or 10-year rates. So I'd rather play that. And if in fact, the S&Ps were to move a little bit lower, dollar yen is likely to track lower as well.
Yeah. Okay, Dave, real quick, about 20 seconds, you're short and fizz. Tell me the case real quick.
Yeah, I've been short that off and on for the last couple of months. Again, I'm not a macro analyst, but common sense tells me when I go to the grocery store and I see 20 million different varieties of carbonated water and they're all competing for price, that tells me there's margin contraction. Technically, if we get below 39.50 on fizz, I want to be shorted again. In fact, I'd be shorting it into this recent rally. We're currently trading around 42 bucks. I like shorting it again. I think we go into the low 30s. Just because of margin compression and the fact that they don't have a built-in moat. It's a commodity. Anybody can get into the business. Pretty simple.